Hi, I'm Jimmy. In this video, I wanted to follow up on my last video where we did a quick review of where the US economy stands by looking at various economic indicators to see if it looks like we're going to head into a recession and in theory would meaningful pullback in the stock market, or do we think the economy is going to get stronger and will ultimately make the stock market move higher as well? So I got a lot of comments asking about other indicators that can be useful when trying to get more information to try to determine whether or not we think now is the time to invest in the stock market. So here, I'm going to look at more indicators than we did in the last video, and hopefully this will give us a better understanding of where we think the economy is at and whether or not we should start investing right now. So if you saw our last video, here's a recap of the conclusion of that last video. If you didn't see that last video, well, you can see a link in the description below. It might be useful for you to jump over and watch that, either before or after this video. Doesn't really matter. So basically, we had two red flags in both housing starts and manufacturing, which have both gone slightly negative recently. Although housing starts was slightly offset by the fact that we had stronger pending home sales numbers. I don't have pending home sales up here, but basically we used that to complement housing starts, and that sort of put the housing starts in sort of the gray area. Then we had unemployment and consumer confidence. Both of those looked pretty good. And that's pretty much where we want to pick up this video. So let's look at the first indicator. So this one is non-farm payrolls. This indicator is put out by the Bureau of Labor Statistics, and it's actually part of the labor report, which is where the unemployment report comes from as well. So as we could see, non-farm payroll took a big dip in the last report. This data comes out every month. Now, I don't want to overreact too much to a big dip like this, because as we could see, it's happened twice before over just the past few years. Now, I was curious if this indicator is really useful. Frankly, to me, it looks just like it's a really volatile indicator. I'm not sure how useful it'll be. So I went back to the Great Recession of 2008 to try to identify some possible ways it might be useful. Can we identify any trends? And this is what non-farm payrolls look like leading up to the Great Recession. Now, if we're wondering, this star right here, this is where the stock market peaked. So this was the high for the stock market right before the crash. So my first observation is that non-farm payrolls went negative right before the market peaked. And I also noticed that it looked equally as volatile now as it did back then. So once again, that confirms our belief that we shouldn't overreact to any one number. So I thought this was interesting, but why stop here? Let's test this thesis just one more time. Now we're rolling all the way back to the tech bubble of the late 1990s. Once again, it's crazy volatile. But now it's interesting to see that we have two dips into negative territory. And I also want to point out that the peak of the market was right about here, and we could see that there was a dip into negative territory right before the market began to fall. So both times, before this and before the 08 period, we see that there's a negative number and then the market begins to fall. But there was also a negative number back in 97 when the market was still climbing. But what I think is unique about that situation is how dramatically the recovery was in 97 the very next month. Okay, now jumping back to present day. Now we can see that we had a few dips, but none of them actually went into negative territory. So I think right now is what we need is more information. We need to see what the next few months bring for this indicator. If this number, the most recent number, immediately begins to recover, well then, at worst, we have a head fake like we did back in 1997. But if it stays low or heads even lower into negative territory, then perhaps we're close to seeing a market high. So back on our scorecard here, how do we want to rank this one? And I'm not sure. This number, it's not negative, so I think that seems like a good thing, but it's mighty close. So there is a strike against the non-farm payrolls. How about two checks in the middle? And that seems like a nice way of not making a decision at all. In fact, how about we call this the gray area? Because that's where I think this falls. In the next few months, I think we'll have more information and we could see whether or not this is really going to affect things. But for now, we'll just say it lands on the gray area. Okay, now let's jump over to retail sales. So retail sales looks very similar to non-farm payrolls, and then we had a huge drop off in January. Luckily, today they actually reported new numbers, and we got a positive number of 0.2, which is why you see the number being positive in the swing going back up. But in the same process of checking the efficiency of this indicator, well, let's go back to the 08 collapse to see how this indicator looked back then. Now, I'm not sure how much this chart actually helps us, since the high of the S&P 500 was right about here. And one of the important things to remember about this number is that it measures month-over-month changes. This is how we see big dips and big gains so often. Now, if we were to use the chart, the cumulative chart from the Bureau of Labor Statistics, this is what that chart looks like. For me, this doesn't tell us a whole ton. Even when I zoomed in and tried to look more closely at the individual numbers, I felt it wasn't terribly useful. So if we jump back to our chart and the tech crash, well, we can see that this was the most insightful part for me, and from my perspective, this is the most insightful part and the reason why I want to use this analysis in this video. So at first glance, this chart doesn't look terribly different than the other charts we just looked at. The peak of the S&P 500 was right about here. But what struck me as interesting about this chart was how dramatic the fall off was relative to the other fall offs in the chart. So that dramatic fall off was then followed by a somewhat modest pullback. And if we jump back to today's chart, well, we end up with a very similar situation. A comparatively large pullback followed by the one that came out just this morning, which was somewhat of a weak recovery. So I hate to do this, but once again, I believe that this one falls in the gray area. The excessively large drop-off paired with a somewhat weak recovery could end up being an early warning sign. Or if the recovery continues, it could end up just being noise. Now, this actually supports the investment thesis that I had in the previous video, which was that I believe that the economy is at an inflection point. The economy could go in either direction. Both non-farm payrolls and retail sales could recover over the next few months, and the stock market could keep climbing higher. But that's why I think it's crucial that we watch these as closely as we can, because I think this could give us more information. If it is an early warning sign, these could get worse, and that could tip us off and give us some guidance with the market. So now let's look at ETF flows, which can be an interesting look at where real money is moving. So ETF flows can be interesting to look at when you group them together. And basically what it does is it shows the net flows for ETFs. And often you can use that to try to determine where people are moving actual money. And since large amounts of money gets moved in and out of ETFs, this can offer us interesting insight into the mind of investors. So to illustrate what I'm talking about, this is a chart for the total flow of funds for ETFs. It's not all ETFs, but it's many different ones. In fact, this group of funds is more than 2,000 different ETFs. So broadly speaking, we can see that ETFs generally did well during 2017, which makes sense because the market did very well during 2017. In fact, they almost never had any outflows during 2017. Well, in 2018, the story was a bit different. We can see that there were a handful of times that there were outflows, and that didn't happen in 2017. We also know that during 2018, the market sold off. It had a negative year, especially at the end of 2018. But we can break this chart down even further by different types of funds. Because what's interesting to me is that we can see both November and December had decent inflows, even though the market was falling in those months. The first chart that's interesting to me is the flow of funds into government bonds. The theory is that these are the safest of all investments. And the story is much like we would expect. During 2017, not too bad. There wasn't a ton of action because the market was quite strong. Then, during 2018, well, the flows picked up. And then towards the end of 2018, they picked up significantly. And for me, this is a very interesting observation. But this brings us to the past 2 months, where we can see that inflows drastically fell off in January. And then in February, I know it looks like nothing on the chart, but there was actually $2 million of inflows. Compare that to January, where we had $8 billion of inflows, almost $8 billion. Now, that being said, my first conclusion is that it appears that investors, or at least less of them, are heading to government bonds. So where are they heading? Are they going to cash? Are they going to traditional bonds? Are they going to equities? So when we look at equities, well, we can see that equities had a decent amount of outflows in January, but then a decent amount of inflows in February. Okay, so now it seems that not as much money is going into government bonds, and at least there's been an improvement going into equities. Now, what if we switch to traditional bond ETFs? Well, we can see that they had great flows over the past 2 months. And sure, February was just half of what January was. But it's interesting that government bonds posted a $2 million inflow in February, and traditional bonds took in almost $9 billion. So what does this tell us? Well, it tells me that there is some money moving into equities, but it seems that traditional bonds have been the biggest beneficiary of the uncertainties in the market. And if we think about it, this actually makes a lot of sense. It seems that investors aren't so worried about the stock market, or at least about the economy, that they're fleeing to the highest safety items like government bonds, at least not as much as they were. Although some investors are still heading there, because I want to point out that the reduction in government bonds was not an outflow, it was just less of an inflow. It also tells me that there's enough fear in the market that perhaps the yield and safety of traditional bonds is good enough for investors right now. So once again, I'm going to have to put this in the middle ground on our little scorecard here. So for me, it's possibly a positive thing, because in my eyes, the next step after leaving government bonds and going to traditional fixed income would be to leave fixed income and head over to equities. And if that happens, then it's possible that the market gets pushed higher. But I'm not too confident right now that I would take it out of the gray area. So how about we just do one green check mark, but keep it in the gray area? All that being said, I think it's important to point out that very rarely are there going to be such clear and obvious signs regarding the direction of the market or the direction of the economy. Usually, we're going to have to dive through as much data as we can to try to make a determination, or at least an effective determination, as to where we think things will go. And if we're not careful, we have to try to avoid having a bias, because if we believe, just our personal belief is that the market's going down and the market's going higher, then we tend to put on rose-colored glasses and see all the data through that lens. And that could be a very dangerous thing. So if you ever see me doing that, call me out in the comments below. I don't want to do that. So if I'm missing something, or if you see it differently, please throw in your 2 cents. So let me know what you think of this analysis, and hopefully you get a chance to watch part 1. Either way, let me know what you think in the comments below. And if you haven't done so already, hit the subscribe button and hit the thumbs up. And thank you for sticking with me all the way to the end of the video, and I'll see you in the next video. Thanks.